would you characterize the inflation report today, and how do you expect the Fed is reading it?
I think there really wasn't much news in it, unfortunately, because I think it was more or less in line with expectations, both at the core level and at the headline level. I think, on the one hand, everybody is sort of watching what's going on in the Gulf and whether that might give some relief to energy prices. On the other hand, they are seeing core numbers slowing down ever so gradually. But I think we're still stuck with the same structural problem that we've had going back 5 years, which is that the Fed's preferred gauge on inflation is still not meeting its target of 2%. And I think it was Christopher Waller who said recently, we can't now expect it just to go away by looking at it. We may have to do something here. And I think that's going to sharpen the debate, regardless of today's data, when they convene again, I guess first in Jackson Hole, but really at their September meeting.
You do get a sense, Christopher, and it's great to see you, of exhaustion. You look at the bond market. I mean, yields are barely moving on this. Stocks are kind of floundering, and we've had a big move when you look at what happened in the markets last week. Are we in a world where a single indicator like this is unlikely to move the markets?
It's a weird time. I mean, I don't mean to use technical economic jargon with you, but it's a weird time.
No, same.
I think we're seeing a jobs market, if you just look at the numbers, right? We're growing at 2%. We've got 3% inflation. We've got 4% unemployment. We should all go home and feel good about the world. But I think we're all looking through these numbers to seeing maybe some weakness on the growth side, some very unevenness in the sources of growth, a lot of it going into AI and corporate spending, weakening job market, weakening consumer spending. And then on top of it all is the geopolitics and some sense that I think, that we all have when you talk about being exhausted by it all, is this conflict in the Gulf that continues on and on and on. And frankly, even if there is a deal that is struck, it's not going away. The uncertainty is not going to go away. And I think increasingly markets are starting to look through, we're going to be living with this uncertain supply of oil, gas, aluminum, other key commodities for a long time.
Mm-hmm.
Well, this is actually something we spoke about with Wendy Sherman, the former architect, the chief architect on the U.S. side of the 2015 Iran nuclear deal. She didn't suggest just a long time that this may be the status quo in the Strait of Hormuz. She actually went as far, Christopher, as to say this could last forever. Listen.
I think unless the United States is ready to either allow Iran and perhaps Oman to have voluntary tolls, or to give Iran so much relief from sanctions and frozen assets that it's worth their while, I don't think we'll get it open for any sustainable period of time. And I think the reality is, for the foreseeable future, if not forever, Iran will control the Strait of Hormuz.
Is this market right now positioned for that forever scenario, Christopher?
Well, as you know, forever is a long time. But I think it's not positioned. I think it is looking very much for some news of some kind of a deal and some ships starting to sail both out of the Gulf and into the Gulf. And I think Wendy, who has more experience negotiating with Iran than I think most people in the State Department or elsewhere in Washington, understands that not only is Iran now holding on to this new leverage on the Gulf, but we haven't even begun to talk about the other issues underlying this conflict, whether it is the proxy militias that Iran continues to support, or indeed the nuclear path of its program. So I think there are a lot of questions on the table, and we are realizing increasingly that we have very few levers to solve these problems.
Yeah. I want to point you to the Beige Book, which I read in my free time, Christopher, smart as I know you do, in the 1st District, which is where you are in Boston, and that includes the Northeast here. Community Perspectives. This is really something to read. Usually people tick through consumer spending, they look at manufacturing and see what some of the contacts are saying. All the way at the bottom, Community Perspectives, contacts serving low and moderate income households report increased demand for assistance along several dimensions. as families struggle with persistently high prices of food, housing, and transportation. Reliance on food pantries, Christopher, is up. Nonprofits are getting more requests for help with housing payments, healthcare supplies, and lower income consumers are adding credit card debt to pay for essential goods. This is the definition of the K-shaped economy. What does it mean for the political dynamic going into these midterm elections?
Well, I was reading my beige book at the beach last week, and unfortunately, a shark
Good
came along
job.
and grabbed that out of my hands before I got to that section.
Hate it when that
But
happens.
I think what you're highlighting is a problem we've been seeing in the macro data for the past couple of years, as both household balance sheets at the lower quintiles of households have been building up. Wage gains have been increasingly eroded by inflation. And then you just sort of see it, I think, when you go to some large cities, the number of homeless people, you hear more stories about people being evicted from their homes. And as you point out, or as the Beige Book points out, the increasing draw on food banks, charitable institutions, and the like. I think it's one of those things where we, for a long, long time, have not had a very robust safety net when things start to weaken. The problem in many ways is that we are living in an economy that may be overheating on the other side with this massive investment, with these stock market gains. And so if you're the Fed and you're trying to adjust, it's a really hard balance to strike. And that's where you really need fiscal policy to step in and say, maybe we're going to tax a little bit more here where things are overheating and inject money over there where they're starting to weaken.
Overheating, you say, Christopher. You're in the camp that we may be overdoing it on all of this investment?
I just don't know. Hundreds of billions of dollars for data centers just feels in my bones like, shouldn't we slow down a little bit? And well,
does it feel in your bones like I've been through this before, .com-y?
Well, yeah, and I wasn't around for the great railway boom, but it's one of those things where everybody is racing to build out more capacity. At some point, we'll need it, but making sure that the revenue lines and any hint of a profit, a wisp of a breath of something that looks like profit, looks like it's increasingly being pushed off into the future. So I do worry about that.
Well, it's interesting
and I
to
should
the
say,
extent.
and I'm sorry to interrupt. I should say,
Yeah.
I think the other piece of this is that AI has now become such a central portion, a central pillar of national security policy, that no government in Washington, whether it's a Republican or Democratic one, is going to allow the train to slow down anytime soon. And in fact, if there's going to be any kind of hiccup along the way, we're probably going to get government money coming in at some point or other.
Well, maybe you just answered my question, because it is interesting the extent to which the administration and at least Republican politicians are pushing the AI race and kind of holding off the idea of regulating this very quickly developing technology. And I know that there are political dynamics here to the extent a lot of Democratic lawmakers see it very differently. Bernie Sanders is calling for a pause in AI development. You've seen a mixed sort of political dynamic when it comes to data centers. But do you think that this AI spend outlives this administration, particularly if there's a Democrat in the White House?
Oh, absolutely. I think it will. I think it will. Even with this pushback, and I think people don't like the electricity prices, they don't like data centers, but they kind of like AI. And the economic gains from it, I think, are going to be irresistible. I mean, there are a lot of things in this world I'd love to pause also, but I think it's just unrealistic to expect that to happen, even within the U.S. What I think is also interesting is the dichotomy between how we are approaching things here in America, which is we need to build the biggest, best, fastest model possible, and approach whatever that artificial general intelligence line is called. Whereas in China, it's a much more, how do we get these tools that are pretty good, even if they're not the best, out into the economy so that manufacturing, education, healthcare, transportation, they become immediately useful, even if they're not, at their finished stages yet. So I think that's a very interesting difference between how two countries are approaching this so-called race and how we're really never going to declare a winner. It's really a question of how these tools, as they develop, become incorporated into people's lives, companies, business models, and investment returns.
Well, let's talk about how two countries are throwing money at something else, which is the United States and Japan throwing a lot of money at trying to shore up the yen. Obviously, Christopher, we're not too far off what was the first joint intervention we'd seen in decades, and yet the effects seem like they were short-lived. Dollar yen climbing back toward that 160 level. Are they going to have to intervene again? Was this ineffective, ultimately?
My goodness, haven't we learned some lessons over the past almost every single intervention in currency markets, that if the fundamentals aren't there, if the interest rate differentials remain, you can intervene for a couple of days and it feels good. And my goodness, if somebody should know this, it should be Scott Bessent. And so I think what we have accomplished, or what he has accomplished, is to flush out a lot of the shorts who had been driving the yen lower. But as you point out, the exchange rate is sort of back to where it is. And there has been very little progress in narrowing the differential between U.S. rates and Japanese rates. So you would expect those shorts to start picking up the pieces where they left off. And I just don't know what the next step is if you're the Treasury Secretary. And then this, of course, leads to the risk that, others have pointed out, which is that the real reason we're intervening with Japan is not because the president likes the prime minister or Japan is a great ally, but it's because Japan is the largest investor in U.S. treasuries. And if there is a sell-off of U.S. treasuries in Japan, that makes America's interest rate costs that much higher. Just all of those kinds of nefarious things that higher interest rates do to the U.S. So I think that's the Treasury Secretary's near-term gain, but I don't know what his next step is now that he has sort of fired this first bullet without a lot of return.